Understanding return on equity, ROE. Return on equity, ROE, is a vital financial metric that offers insights into a company's profitability and efficiency in generating income from shareholders' equity. This article will delve deeper into the calculations, significance, and limitations of ROE, along with its comparison to other financial ratios. What is return on equity, ROE? ROE is calculated by dividing a company's net income by its shareholders' equity. Mathematically, it can be represented as \text ROE equals frac text net income text shareholders equity. Key insights. Net income, this is the company's profit after all expenses, including interest and taxes, have been deducted. It is essential to consider net income before any dividends paid to common shareholders. Shareholders' equity, this represents the net assets of the company and can be calculated as total assets minus total liabilities. It reflects the capital contributed by shareholders through investments or retained earnings. The importance of ROE. ROE serves as a gauge for a company's profitability and operational efficiency. A higher ROE indicates effective management and strong growth potential. It signals that a company can effectively convert investors' equity into profits. Industry comparisons. It is important to note that ROE can significantly differ across industries. For example, utilities typically showcase lower ROE around 10% due to high assets and debt levels. Technology and retail firms generally have higher ROE, often above 18%, owing to less substantial asset bases compared to net income. Norm reference. A useful benchmark for assessing ROE is the long-term average of the S&P 500, which is around 21.71% as of the second quarter of 2024. An ROE below 10% is generally considered poor, while an ROE near the S&P average is seen as acceptable. Calculating return on equity. To achieve a precise ROE calculation, it is best practice to base it on the average equity over a specific period. This ensures accuracy in aligning the net income earned with the appropriate equity amount. Calculation example. Using average equity balances for accurate representation, the calculation process follows these steps. 1. Determine the net income from the income statement, using the trailing 12 months for more accuracy. 2. Fetch the equity balances from the balance sheet for the beginning and end of the relevant period. 3. Calculate the average of these equity figures to use in the ROE formula. Using ROE to evaluate stocks. Estimating growth rates. Investors can leverage ROE to get insights into potential growth rates of stocks they are monitoring. The future growth rate can be calculated by multiplying ROE by the company's retention ratio, the proportion of net income retained in the business. Text future growth rate equals text ROE times text retention ratio. Sustainable growth rate, SGR. The sustainable growth rate represents the upper limit growth a company can achieve without financial leverage. The formula is similar. Text SGR equals text ROE times text retention ratio. For instance, if Company A has an ROE of 15% and a retention ratio of 70%, its sustainable growth rate would be 15% times 70% equals 10.5%. Conversely, if Company B has the same ROE but a 90% retention ratio, its SGR would be 15% times 90% equals 13.5%. This comparison can help investors determine if a stock is overvalued or undervalued based on growth expectations. Recognizing risks in ROE. While a high ROE is typically favorable, extreme values can indicate potential issues. Inconsistent profits. Companies with fluctuating profits may show misleadingly high ROEs after a profitable year following a string of losses. Excessive debt. A high ROE may arise from significant leverage. High levels of debt reduce equity and inflate the ROE ratio. Negative outcomes. Negative net income or negative equity can generate misleadingly high ROEs. If a company has negative equity due to heavy debt or poor performance, it indicates potential financial troubles. Limitations of ROE. While ROE is a valuable metric, some limitations should be recognized. Negative ROE. If a company has a net loss or negative shareholders' equity, ROE can't provide meaningful insights. Industry variances. ROE is less useful for comparing companies across different sectors due to the variations in capital intensity and operational structures. Not comprehensive. ROE is only one metric, and investors should use it in conjunction with other financial indicators for a complete analysis. Contrast, ROE versus return on invested capital, ROIC. ROIC offers a broader perspective by accounting for all sources of capital, equity and debt, rather than focusing solely on equity. It provides a clearer picture of a company's efficiency in using its total capital to generate profits. Conclusion. Return on equity, ROE, is a crucial tool for gauging a company's profitability and efficiency from shareholders' equity. While it offers valuable insights into company performance, it is essential to contextualize ROE within the industry and consider it alongside various other financial metrics. By understanding its nuances, investors can make more informed decisions regarding their investment strategies and risk assessments.